Okay, good afternoon. I would like to welcome you to the Sustainable Change Alliance conversation on entrepreneurs and investors in the renewable energy world. And for that, I'd like to introduce Matt Riley. Matt, if you maybe can just raise your hand so they know. Matt Riley, who's the head of Grid-Scale Renewables for ENGIE North America, and Owen Barrett. Owen, if you can raise your hand. He's the founder of Lumeo and ZNE Capital. I myself, I'm Titus Brenninkmeijer. I'm a member of the Sustainable Change Alliance. I'm a board member. And I also run Solgenix. It's an investment company that invests in privately held energy companies. Sustainable Change Alliance is an impact-oriented, member-based, not-for-profit educational group. We are focused on impact investing, which we define as bringing financial and other resources to double and triple bottom-line organizations that are trying to address big social, environmental, or health-related issues and trying to do that in a sustainable manner. Some of those organizations are for-profit, some are non-profit, and some come from the independent sector. I'd like to acknowledge the hard-working and dedicated Sustainable Change Alliance board members in the meeting, gratitude for our members on this call, and finally, we couldn't do any of this without others, who are the founding sponsors are Argyle Capital Partners, Impact Family Office, Maps.com, and UBS, and the platinum sponsor is Nixon Peabody Law Firm, and silver sponsor is Brashears Insurance. If you're yet a member of Sustainable Change Alliance Foundation, we encourage you or your organization to join us on this journey. Visit sustainablechangealliance.org, where you can sign up as a member. Just for you to know, the meeting is being recorded. Everybody on mute, except for the guest speakers and myself. And if you have any questions, please use the chat room so we can pass on those questions to the speakers. So what I would like to do, Matt and Owen, so Matt, maybe if you start, maybe take 15 minutes to talk a little bit about your experience as an entrepreneur in the renewable energy world and your experience with different type of investors that you had. And then Owen, maybe you can do that afterwards. And then afterwards, we'll open it up for questions.
Sure, terrific. Thank you, Titus. And thank you to everybody. Alliance. It's delighted to be here. I'm actually a member of Sustainable Change Alliance. For those of you that don't know, I'm a recent member and known of the organization for quite some time. And I'll say that I was also a company founder through a company that did renewable energy development, founded the company, brought it all the way through to company sale, full cycle. So I can tell you that the ultimate goal of an entrepreneur is actually to become an SCA member and then start to do investments. So I'm a living example of that. It's the high water mark. It's the objective we all try to achieve. So I'll start off with my career in renewables actually started with a gentleman that many of you know because he's spoken to the SCA before, and that's with Clipper Wind Power and Jim Dielson. So for those of you who heard Jim Dielson talk, I don't know exactly when that was to the SCA, but and he might have been talking about other ventures that he had, but he had a very successful wind turbine technology and development company down in Carpinteria. And I started with Jim and Brent at their company in 2003, straight out of the Bren School of Environmental Science and Management at UCSB. While at Clipper, my job was to prospect new wind farms. And I learned that skill set. And after about 5 years, I decided to start my own company called Infiniti Wind Power. And eventually it was called Infiniti Renewables when we started to do some solar. And it was the same exact activity set that I was doing when I was at Clipper, which is prospecting new wind farms and getting them through the stages of development and ultimately into construction, and generally selling those projects right prior to construction because they tend to cost hundreds of millions of dollars to build. And I was kind of a small development shop to move these assets into that world. 10 years later, we sold the company to ENGIE North America. ENGIE's a $40 billion French utility, has a big presence in North America, does a lot of energy as a service businesses, And we became their grid scale platform for wind energy, and just recently wrapped in all of the solar activities. Some metrics for folks in my time at Infiniti and with ENGIE collectively, but mostly this is sort of Infiniti projects going into construction, and then the legacy of those assets being built in the last couple of years. Put in about 4.5 gigawatts of renewables. That's roughly about $7 billion of capital investment, and is roughly represents about a million and a half households worth of electricity usage. This was a local company. This was a company started in Santa Barbara by myself and Derek Harding, my co-founder. Always been based in Santa Barbara, and we always said we did a lot with a little. We got a lot done with a relatively small company for the amount of megawatts we put in, which is a measure of energy, and therefore a lot of success and achievement. I'm very proud of that. The Infiniti Capital story starts off in 2008. We launched the company in April, got our first round of funding in 2008, and I'm sure many of you just broke out into a cold sweat because you remember that time as being the beginning of the end for the economy. And you know, we signed our Series A. It was a several $1 million Series A, $5 million total commitment in two stages of funding. The first tranche came in the beginning, and then the second one was due to come in October. The reason for that is that they were worried that maybe I was leaving with trade secrets, and they just wanted some time to elapse, which of course was not really a risk, but I said, okay, no problem. Now in those 6 months, obviously, I think 2 or 3 weeks before the second funding, the Lehman Brothers went under. I mean, the whole world was collapsing around, and so you can understand that the investors were a little skittish to put in their second tranche, and most of them did not. One did. Basically said, hey, my word, my handshake is my word, and I told you I would, and even though the world is collapsing around me, I'm going to do it. And I thank that gentleman every day. Every time I talk to him, I say, you know, it meant the world to Derek and I that people really stood by us and our management team. And that meant that in 2009, we were talking with some local investors about, hey, we need to pick up the slack. You know, it's an expensive endeavor to go develop wind and solar projects. And we wanted to talk to the community about, you know, who wanted to participate. And it was a very challenging time to raise capital for anything, but especially something like renewable energy development, which is both a sustainable investment, but it's also a real estate investment. It's also an energy investment. It's actually kind of a platypus, so nobody really knows what it is. It was a little bit hard for people to get their head around it. And we really, frankly, we failed in finding a new set of angel investors to kind of replace the folks that we had before, or supplement the folks we had before. Until we found a private equity partner that ended up in late 2009, ended up finding complete and total alignment. They understood exactly what we were doing. In fact, they were doing it already with some other partners. We connected with them, and we were off and running, and ultimately ended up deploying 9 figures worth of funding and capital, and having huge successes in all of the numbers that I just talked about and the exit strategy. The original investors were part of that ride. At that transition, we had to also obviously change some of the fundamentals of governance. But in the end, when we did the exit and as we're kind of winding down the entity, you know, those guys enjoyed a very healthy 20x plus return. I mean, it was very, very, very good. I'm sure it was the best investment they made, or the best thing that ever happened to them in 2008 was them putting that capital into our company. With time, if given some time, I can go through kind of, I think, what their approach was when they invested us originally. I think that some folks here might be interested in that if time allows. I'll also, so some themes that kind of thinking about this discussion that I'll just kind of throw out there that I already mentioned that the asset class is a little hard to get your hands around as an investor. It's a little hard to fully understand and appreciate some of these sustainable investments in terms of an entrepreneurship, in terms of Series A or friends and family. So it takes a lot of work to get to a point where, as an investor, you really understand the fundamentals of the executive team and the business model. And we have a lot of smart people on this phone that I'm sure have tried to navigate that. Some, I'm sure, successfully. Some probably was more of a challenge. And I'm happy to talk through that. And the concept of alignment, I think we actually got to a place of alignment with our private equity party in 2009. And I'm happy to talk about that a little bit. About that was really the secret sauce of the success of the company for the following 9 years, was finding that relationship. And then a little bit about investor profile, and I think Owen's going to touch on this. I'm using this as a segue, Owen, for you. It's about who were we talking to at the time when we were raising money, both my initial raise in 2008, which I did talk to several investors before we landed on the ones that did invest, my subsequent, cold calling people in 2009, and then finding the right partner in late 2009. And I'm more than happy to kind of talk through that as well, time permitting, Titus. So with that, I'll hand it off to Owen.
All right, thank you, Matt. Thank you, everybody else. It's great to be here. Exciting to talk to like-minded folks. My professional career started also in 2008, but it was, I wasn't getting started in entrepreneurship. I just graduated school in finance, and I was watching the finance industry just melt to the ground. So it was an interesting time to get a degree in finance. But over the next 3 years, I worked in finance, and I really found that I had kind of a sweet spot for using money to tell a story. So convincing people to make decisions based on the economic sense of those decisions. I did not like the finance industry, so that's what led me to the Bren School. I wanted to kind of blend my passion for economics and finance with sustainability. So I went to the Bren School. My goal was to somehow end up in the corporate sustainability department of a big organization. And that's exactly what happened. I ended up in San Diego working for a Fortune 500 company as an energy manager. So I oversaw I think it was a $45 million annual utility budget of a huge company with, 80 sites around the world. And it was my job to figure out how to save them energy. So I had absolutely no experience. It was pretty intimidating, but in a very short amount of time, I got experience with fuel cells, battery storage, solar PV, HVAC optimization techniques. And then the last project that I worked on was an LED upgrade across the entire real estate portfolio. And what I thought was really interesting was the leadership at the company was all old GE guys. So I spent most of my time trying to convince the CFO and the CEO to invest $10 million in a fuel cell, or $5 million in a huge battery energy storage system. And it took a lot of convincing. And then when I got to LED technology, they basically wrote me a blank check and said, more efficient light bulbs, I get it. And that for me was kind of the aha moment of, if these old conservative guys are welcoming LED technology like this, I wanted to go start a lighting company. And that's how Lumeo started. So I left the job. I started Lumeo with really no idea of what to do or how to do it, other than I really understood the financials behind lighting upgrades to LED technology. And we totally failed our first 2 years. I mean, we had no revenue, no customers. We were not getting any traction whatsoever. I had to sell my 401k to basically survive. I was trying to go to Tech Coast Angels. I was doing everything that everyone says you're supposed to do, trying to pitch this story to get some working capital. And it didn't work at all. Going to kind of Matt's point, I couldn't seem to find the right, everyone want to invest in like a widget. And we were more of like a consulting type company. We were selling other people's technology. So just could never find the right fit. Fortunately, at about that time, I kind of stumbled into this niche opportunity with schools in California, where it's just all the kind of factors came into alignment, and it was the right time that schools started focusing on energy efficiency and renewable energy. And in about 18 months, we ended up working with 40 schools and school districts all across California and hit 8 figures in revenue. So kind of everything changed overnight. It was amazing. It was like totally overwhelming. I didn't, we had a hard time dealing with the growth and everything that comes with that. But that experience then led me to what I'm working on now, which is kind of combining real estate investing with clean technology. So I don't know if any of you have read Rich Dad, Poor Dad. I read it probably 20 years ago and it piqued my interest, and I never had the capital to invest in real estate. So when Lumeo started doing pretty well, I started investing passively into multifamily real estate deals. And what I noticed right away was another niche opportunity. It was that no multifamily operators or syndicators were incorporating any energy upgrades into their projects. And so I just started kind of modeling large commercial solar installations into large apartment acquisitions, so 100 plus units per property. And in most instances, it makes the financials of the deal work better. So that was kind of the inception of Zero Net Energy Capital. The goal is to buy apartment complexes, use solar as part of the value add strategy, and in the process of doing so, create a lot of zero net energy apartment complexes. And we're sort of in that same place of trying to find investors, seeing what the right fit is. Are we a real estate company? Are we an energy company? Are we going after real estate dollars? And those people generally don't understand energy. Or are we going after energy people, energy investors? Those folks generally don't understand real estate. So it's definitely, it's challenging again, but thankfully we have like a very long track record of real estate investment has made a lot of people really wealthy. So I think it'll be an easier story to tell for us than Lumeo and what we were trying to do there.
Now, one of the things, I mean, that you both actually mentioned is the alignment of the investors. How do you find that alignment? And it's interesting, Matt, that you were saying that you actually found a lot of alignment with these private equity investors. Was that they had the know-how already, or were you able to educate them, let's say, with regards to the investments that they're going to do? How did that process work?
So I talked with a lot of investors prior to my Series A, and both my Series A and you can call it my Series B, but really it was my Series Infinite. I don't even know, we didn't even do rounds. We just started dumping money in projects with the private equity, but both of them had done their homework. They understood who I was and what I was doing. That was the only way that those deals happened. All the other conversations I had where folks didn't really understand wind power or development, those were much more challenging. And so from the second thing you asked about, experience, they definitely came in with, they knew exactly what I was doing. And in fact, my Series A guys were doing that in solar already. They're trying to think about geothermal, but they knew that in wind they were behind and they needed kind of a thoroughbred executive team to go do wind. And so they just knew it. And they found us right at the right time as I was leaving one of the larger developers in town. It was a perfect match with the Series A. Now with the private equity, it was the same thing. We kind of ran into them in the field. They said, these guys are really great developers. We, rather than trying to compete with them, we absolutely need to be just funding them. And we ended up becoming, and their model was really unique. And what I loved about it is that their capital was extraordinarily patient. Everybody says their capital is patient. These guys actually had patient capital. There was it was a business model where they were deploying a lot of tax-exempt investors, hospitals, universities, that sort of thing, and they were doing it through more of a real estate royalty mechanism. And when Derek and I really started to understand this, we thought, wow, this is great. We should get our returns like that too. It creates passive income for us for the rest of our life. Maybe I'll become a rich dad and not the poor dad. So we just started to align our mentality with exactly what our investor wanted to do and share in those returns. And that was when everything went beautifully. And with the Series A guys, there were a lot of moments, and this is sort of the cautionary tale to a lot of folks on the phone. There were a lot of moments where they were playing off of the venture capital 101 playbook, and that didn't align with our business. So we definitely had some conflict there that ultimately I just, ended up doing what I wanted, and it was a huge success for them. But, if we had to have been influenced by that mentality of that kind of put capital in, get it out, kind of thing, we wouldn't have lasted more than a few years. And so I think, that's one thing that, as I go out and I try to invest in friends and family rounds or Series A, I can say that I'm value add, that I'm going to help you with, with managing your company. But I really got to be honest with myself about, what are my incentives as an investor, and just make sure that executive team has as perfect of an alignment to those objectives as possible, and definitely transparency into those objectives. So I think that's really helpful, especially in times of stress, like 2009, when it was a financial, we were recovering from a financial crisis. That's when those things become even more important. I don't know, and you want to chime in on that?
Yeah, I mean, we obviously have not had the same success as Matt with matching up with the right private equity folks, but we've had a lot of conversations with private equity groups. Our challenge is we talk to private equity groups that are in real estate, and they, for the most part, only want to invest in Class B or Class A new development type deals. Most of our deals are kind of Class C, a little bit older, vintage apartment complexes. And then from the energy side of the equation, they have never done investments into real estate. So it's just, kind of like Matt keeps hitting on, it really does, it seems like, I mean, I'm not speaking from first person experience, but it seems like it part of the challenge is finding the right either individual or investment group that understands energy touches a lot of different industries, I guess, or areas, and it's not quite as black and white as some other like tech startups.
Yeah, and maybe I'll add, Titus, because I think it's important that folks understand, what Owen went for on the first company was kind of an as-a-service model, which exists in sustainable impact investments. What he's going for in the second one is big deployment of capital in large real estate type investments, and scale matters for what everybody's trying to look for here, right? Do you want to be a key contributor as a Series A investor into the management of the, in management, and really kind of, and that's maybe on the smaller scale. But what Owen's trying to do on ZNE and what I did at Infiniti requires a lot of capital. I think I mentioned I spent over $100 million over that, deployed $100 million over that plus or minus over that period of time. So you have to ask yourself, where do you want to be on this? Spinning wind turbines is really great, and big, huge solar projects are really great. But as a angel investor, as an individual investor, how do you get into that market? I mean, we can go into that, but it's a real challenge to kind of get in there and get in with the right executive team that then goes in and finds other capital to probably deploy into the real estate or the larger projects.
Yeah. Listen, I'm sorry, I just had a little bit of a problem with Zoom. So I just got out of the Zoom, the chat. So the questions that people sent to me, I lost those. So I'm sorry if you had questions that you sent to me via chat. Can you read? Because I actually, through that disconnect, I lost those questions. Yeah, thank you. And now one of the things, so I missed a little bit in between, but I mean, one of the things you talked about, the positive alignment that you had with investors. What were some of the negative experiences that you had with investors in dealing with that, either Matt or Owen?
Yeah, Owen, you want to start with this one, probably?
Yeah. I mean, so Jigar Shah is one of the most famous people in the solar industry. He basically came up with the power purchase agreement, which led to a lot of great things. He now has a capital deployment company called Generate Capital. And we got really, really far down the road talking with them about our model and how they loved it, and it was really innovative. But at the end of the day, for every dollar that they would have invested into us, maybe 30 cents goes to solar because we're trying to acquire the underlying real estate. So they got to this point where they just couldn't do it because they've never done it before. They need to have higher thresholds for how many cents of every dollar actually goes into energy. So, we hit a dead end there after 3 months of going through due diligence with them. Then we talked to, I kind of mentioned it before, but we'll talk to there's a lot of private equity and family offices that put dollars into real estate. Most of those groups focus on Class B and Class A properties. And, I don't know if there's real estate people on the call, but Class A is new development. Class B is like less than 10 or 15 years old. Class C is everything older than 10 or 15 years old. Our model works best for Class C because we're looking for master metered properties on the electrical side. So we want 100+ unit properties with one electrical meter because that's really easy for us to do a solar installation on. Those types of properties generally tend to be a little bit older, and those private equity groups are not comfortable with older inventory. So we've had really good calls with different groups, and everyone, commends us on the approach, but at the end of the day, it just hasn't really fit the exact model that groups are looking into. So we keep kind of running into some roadblocks.
Mm-hmm.
Yeah, Titus, I've got 2 examples of things that didn't go so well. One is that when the financial collapse happened in our Series A, we started to have board meetings about, okay, what does this mean? How much capital do we have? How long does it last? Look, it's going to last maybe a year and a half. Their formal recommendation to me was ramp it all down, go to a skeleton crew, pay only the basic expenses you would need to survive, just wait it out, pay yourselves enough to pay your rent at home and stuff. And I said, God, my business is all about, I have to create these assets. The only way I'm going to survive is if I attract capital to these assets or attract capital to my company. And if I ramp down, I'm damaging that ability to do that. So screw that. I'm ramping up. I'm taking my runway from 1.5 years to 6 months or 3 months or whatever it was. And I really had to kind of do it in their face. I just say, look, I disagree. I'm going to do it a different route. Now, I just did it. It worked out, found the investor. Everybody's happy. They made a massive stockpile of money on the investment. I don't know that they would see it the same way if they look back at that. That's how that went. The second thing that didn't go so well is that they had a structure where they had a managing partner. And the relationship with that managing partner deteriorated over time. And I think that the other partners in that group, and I think it's maybe about a dozen of them, really should have paid attention to that, because they had in Derek and I the best executive team you could possibly have. And I feel, obviously I say that with a lot of confidence. Some might think it's being cocky, but we were really, really good. And the last thing you would want to do in a company like that is to start to take actions that really alienated your executive team. And that one individual did. And by the time they realized this, it was sort of too late. And so, we ended up starting to take actions to try to remove those folks because we didn't want them in our lives anymore. Now that could have been dealt with by just maintaining a really positive relationship with your executive team. There was no reason why that had to go like that at all. By all accounts, there was really nothing that happened between 2009 and 2018 that would have precipitated that, other than somebody just wanted that to be how the relationship went. So I think the other investors really suffered in that, and I think that's a lesson for those of us that look at those types of structures. If you do have a general partner in there, who is this person? And if they have to be in there for 10 years, how's that going to go? And what if you just don't agree with them anymore? How are you going to kind of change the strategy?
Mm-hmm. Mm-hmm. Now, I have a question that came in here with regards to what's your experience with local, state, Fed government funding? And what are your thoughts on proposals for a Green New Deal?
So, I mean, most of our, I think there is a place for us to go after state and local funding if we go after low income housing. And low income housing, you know, has a very specific definition. So we prefer to position ourselves in the affordable housing space, which is less bureaucratic than low income. So we haven't really gone that route yet, but I mean, it is, for us, it's definitely an option. We are just, I'd say we're more committed to environmental impact than we are social impact. It's still on our radar, but we want to be, you know, the only zero net energy real estate developers out there. That's our goal. That's what we're trying to do. That's where our expertise is. If we down the road can wrap in low income and probably bring someone on the team that really understands that space, I think we'll be well suited for tax credits with local municipalities that want to build or create more low income housing, but we're not there yet.
Yeah, Owen, you need a lobbyist to start getting you some tax credits for folding in environmental benefits into those investments. That's your next hire.
Yeah.
I mean, for those of you that know, renewables is all about the production tax credit and investment tax credit subsidies that large scale wind and solar enjoy. You know, I think the Green New Deal would just make those more of a certainty for a longer period of time, which is great, and also probably fold in battery storage into that mix in a big way. So yeah, I mean, we're obviously supportive of that. I was on a small conference call with Biden and team about this not too long ago. They definitely have big plans if they do come into office in the fall. A couple $1 trillion plan to use energy as a renewable energy as a means to bolster infrastructure investment. So yeah, the renewables industry has sort of lived and died by federal policies related to tax credits. Grant funding and stuff like that, that's been more on the R&D side of the world, and not so much on the development and financing and operations.
Just to jump in one more time, we are in the process of developing a sort of a specific investment vehicle. Essentially, it would allow investors to take the tax credit associated with solar and put it into our deal. So they're basically investing a tax liability that they would otherwise have. So they're earning a return on what otherwise would be paid to the IRS. We're a little bit skeptical to put a lot of time and resources into that because if Trump wins again, or if something happens where the ITC is not extended or not renewed, you know, it's 26% this year, 22% next year, and then 10%. So it doesn't have the same bang for its buck. But there are really unique opportunities to monetize that tax credit with a certain type of person that has a large federal tax liability where they can turn it into an investment.
Don't worry about it, Owen. The tax credits will be there forever. It's okay.
I hope so.
There's another question that came in, is in terms of when you think of private equity investors, beyond the capital, what expertise or contributions do you most value from these private equity investors? And is there also a particular role that you found for these private investors in your organization with regards to board seats, whatever, you know, or management role in the organization? Have you found anything like that?
Yeah, so for mine, there's a couple of different types of private equity that participated in large-scale renewable development companies. I've had some other colleagues that have had kind of the 5 years out, 5 years in model. And I can tell you that forced them to sell their companies probably prior to when they maximize their value, because renewables is cyclical. Again, we've talked about the tax credits and market dynamics, federal leadership, all those sorts of things all play into how well renewables are doing at the national level. And so if you have private equity that kind of needs to take their capital out, put you on the block, that they're going to do that, and they usually have the control to do that. That's not what I had. What I had, like I said, is a much more patient entity that was looking to stack cash flows. And so every single decision went through that lens. And because of that, we pretty much always made a decision that was aligned with their interest and ours, and it was a good decision to make. And we were never felt like we had, a gun to our head to make a rash or a bad decision. And I think that built up a trust level that then we could bring more and more opportunities to the table, and they would be happy to deploy capital against those opportunities. They did definitely have a kind of a control, a certain amount of governance control over expenditures, sort of annual budgeting. They had veto control over us doing weird things besides developing wind farms in a way that made sense. After the first year or two in the building of a trust, I don't even know that we didn't focus on the budget. Let's just put it that way. Things happened because we had great relationships at the top level, and then great relationships at every level below that, and complete alignment, and that led to pretty substantial success.
Yeah, and we like I've said, we haven't gotten funding from private equity, but every time we talk to them, real estate is really an industry of relationships. So even if we have conversations with private equity folks where it doesn't lead to funding, they've almost always introduced us to their brokers, which is huge for us because relationships with brokers is how we find our deals. So that's been kind of another benefit of private equity, aside from capital for us, is really just building this pipeline of brokers and deal flow.
I think that private equity can have good relationships with some of our customers. So for both Owen and I, finding deals that they see, or they have a relationship with some other investment that they're doing, there are opportunities like that at least I've seen that do creep up quite a bit actually in that relationship. It didn't really happen with the more of an angel investor characteristic kind of investor profile. I think there was no lack of desire to want to help. I just don't think it was in our business. There were really lots of opportunities for those folks to actually influence what we were doing in a positive way.
Now, Matt, there's another question here for you about what's your experience in terms of a two-man band doing independent power deals with regards to obviously, competing with much better capitalized competitors?
Yeah, thanks a lot, Jonathan. I thought you said you were going to give me softball. Derek, my business partner, was incredible real estate mind, the best I've ever known, and I certainly built up a level of experience at Clipper, understanding how to develop a wind farm. But between the two of us, I could identify a wind project location. He could secure the real estate. I could get it developed. And the question was, once we got past those initial stages, then we're starting to duke it out with the big boys. Because those initial stages, you have an advantage as a small guy. You can move fast. You can go in. You can go out. You can do all the things you need to do to kind of get things going. At some point, though, you're putting millions of dollars into these projects, and you're taking on a lot of risk. And you better know what you're doing at that point. And I think, Jonathan, it's a good question. I think the first deal we did with Westar, which is the largest utility in Kansas, we did that deal so that we could just do a deal. We just needed to get a deal done. I don't know that we made any money on that deal, but we sold a very large, hundreds of megawatt wind project in Western Kansas. And we could say, okay, look, we did the full life cycle of this one project. We have 10 other projects that we're working on. We want to make that 20 or 30. And now we kind of know what we're doing. And so we did do a little learning on the fly on the capitalization side, on the backside. How do we sell this? How do we sign a power purchase agreement and prove to the utility that this project's even going to be there when they need it to be? A lot of that had to do with trust. Both Derek and I would walk into a room, and you think you guys could tell I'm a pretty direct and open person, and so is he. So when we walk into a landowner's living room or we walk into a utility's boardroom, same message was coming out. This is what we're doing. We're gonna sell this project. Understand that that's a good thing when we sell it to NextEra, which is the largest owner of renewables in the world. that's a moment to celebrate, because now NextEra is going to pull that project into construction and operations, and they're one of the best operators in the world. And so we would set this up as, don't be scared of our business model. Our business model is to get these projects to move through, and ultimately it benefits everybody when the turbines are spinning. So, we're putting our skin in the game to kind of make that happen. And that actually back to the investor, the private equity, they wanted a royalty in these projects. That's how they could make their returns for their tax exempt investors. That ultimately ended up becoming a selling point for us, because the royalty means you're taking operational risk for 30 or 40 years rather than just getting paid a fee when you sell it. And so when you'd say that to people, they would go, okay, well, yeah, you don't make anything if the turbines aren't built. So you're putting your money where your mouth is. That ultimately, we were doing well before. When we could use that message, that was great. And I'm sure Owen will have similar experiences with his investments when he starts, when you kind of start to think about, how are people going to want to view your risk versus their risk.
Yeah. Now, Owen, there was another question for you, is in terms of, is there any place for angel investors in your new business model?
So, because of how real estate acquisitions work, we don't really have a need for working capital. So every time we acquire property, we get acquisition fee. It's anywhere from 1% to 3% of the acquisition price. So that's kind of our working capital. Our deals range from, we have an unit in Tulsa, Oklahoma right now. I think it's 750 grand. So we need 300,000 in equity on that one. Then we have some bigger deals in Arizona that are closer to 20 million. So we need 7 million in equity for that one. So it's hard to say without talking dollar figures. There's always a place for investors. It kind of depends on the check size and what they're looking for. We view our model as a risk adverse way to invest in clean energy, because our returns are they're subsidized by the real estate returns. So we're investing in properties that make sense, first from a real estate perspective, and second from a solar perspective. So even if this doesn't work at all, there's still returns from real estate. So I guess the answer is yes, but it kind of depends on what that particular angel investor is looking for.
Yeah, okay. Now, in terms of renewable energy, obviously one of the big things is always storage. So I guess my question would be in terms of, to what extent, for example, in wind power, are you also looking at storage options, or are you involved in partly developing that, or also Owen, for you, how many of the solar systems that are being installed are being installed with power walls, so with power backups?
Yeah, well, first off, I think if you really wanted to talk to Owen about that, then just talk to him about scale and acceleration, and see if you can get him to, allow you to put some money into the working capital side. But so storage is huge. Like it's the big wave that's coming. Storage. So ENGIE has what's called ENGIE Storage, which is the leader in behind the meter storage. We have like 180 sites in California, mostly in California, but throughout the United States. And managing a lot of behind the meter storage and doing a lot of in front of the meter storage. So that's like the big stuff, the grid scale stuff. And you're seeing storage get deployed in both. You're seeing it happening definitely at the residential and commercial scale. In fact, I'm installing a Tesla Powerwall at my house, I think within the next month. Which, by the way, after just going through the Tesla buying process for solar and storage, it's like they're going to clean everybody's clock. It's just way too easy. But anyway, that's a side note. But on the grid scale, definitely the utilities are really realizing that as they've gone away from fossil, even the stodgiest coal-based utilities are just struggling big time with this, with any of their coal plants, and even natural gas plants aren't really seeing some of the benefits anymore that they used to see in kind of these really peak or super peak pricing, especially in places like California or Texas. And so when storage is deployed, storage is actually kind of designed to shave a lot of that stuff off. And I think utilities are getting wise to this pretty fast. And even the corporations that are buying power, that's a big power buyer. Those of you that have been watching the news, the the Amazons and Walmarts and Microsofts of the world, Google, they are buying power directly from power plant operators. And now they're starting to ask for storage. They want you to shape that power output to more fundamentally match their load profile. Now, there's a lot of different ways you can do that. Storage is one of them. Yeah, Titus, we are seeing major deployment of storage. Now, this business model has not yet been fully vetted. So it looks quite merchant. For those of you that understand that word, it means that the revenues are not kind of stable and long-term and contracted like we've seen in wind and solar traditionally. So a lot of the investors are trying to get their head around this. Like, okay, your pro forma shows a really nice, very early payback, but the fundamentals that go into that revenue stream, we don't really know if you're going to get paid that particular value for whatever part of that value stack that you're showing. So it does take a little bit of weaving that message a bit, but I think storage is going to be a big part of our electricity mix, and it just could be the thing. Just in my career over the last 17 years in renewables, I've seen the power markets just fundamentally be flipped on their head because of deployment of renewables. Zero marginal cost electricity because the sun and the wind are free, as opposed to coal and natural gas. And so when you start to layer in battery storage into that, this just may be the thing that just kind of is the death knell for fossil. It just can't. They can no longer ramp quickly enough or make enough money or whatever. And I think, personally, I'm not apologetic about the fact that I just would like to kill all fossil. So I work for a company that's maybe a little bit controversial, but I mean, that's my personal mentality. So.
Yeah.
And I'll just chime in real quick. All of our projects are behind the meter. Matt's doing both. Unfortunately, so there's two types of ways to make money in real estate. One is appreciation and one is cash flow. Unfortunately for us, the states in which storage makes the most sense, where there's a lot of arbitrage between on-peak and off-peak energy pricing for behind the meter, are the states that do not cash flow. So think California. It's really hard to buy an apartment complex that cash flows here, but it will appreciate. Our investors tend to want cash flow from day one, which are states like Arizona, Oklahoma, Arkansas, Florida, where there's really not a big difference between daytime and nighttime electricity prices. So we haven't seen it work yet. If we were to find a particular investor that only wanted appreciation and didn't care about cash flow, we could put storage in all of our projects in California, but we're not in those markets.
Yeah, okay. Mm-hmm. Now, one of the things we touched upon before is a little bit public policy. To what extent did your companies, or do you get involved in trying to help form public policy with regards to renewable energy in the markets that you're working on, the states that you're working in?
I'd love to get more involved. We're 6 months into building this company, so we're focusing all of our energy on building the company. But I think for governments to not see renewable energy as a huge job creator is just insane. It could be the next big thing. It could be like building the highways if we just committed to a green future. So I'd love to get more involved personally, but again, all of our energy right now is on building this business and getting it off the ground. So we're not doing that yet either.
Yeah, Titus, for ENGIE, it's fundamental to the success of the company. We have a very, very good policy and regulatory group that is incredibly active. I mean, we actually just needed some relief on tax credit timing, and that was received a few months back. Not we, the whole entire industry did, all the way down to the county level. I think there's just a lot of work to do. You can't be in these businesses without being heavily involved.
No. Now, there was one more question here regarding storage, Matt, and I guess the question is towards you. Is ENGIE considering hydrogen storage? Is that an issue?
Yeah, big time. Yep. Big time. ENGIE believes in hydrogen, fundamentally believes in hydrogen. In fact, we are I've recently steered some of my executive team resources to be focusing on it. I think it's I do believe that it has a big place within the energy ecosystem. Where exactly it'll happen, why and how, we still need to iron some of that stuff out. I'm not a big believer that it's going to be passenger vehicles, but there are a lot of other places where hydrogen can be used that can create major lucrative revenue cash flows paired with wind, solar, and storage. So yeah, we're definitely looking into that as an organization, not just in the U.S. ENGIE is looking into that globally at this point.
Okay. Now, you both graduated from Bren, right? So the question came up here in a certain sense of saying, what role did that program play in your career, and what are the other things that you would have hoped for that could have assisted you as an entrepreneur in that program?
Well, I would have loved that the EcoE program existed when I was back at Bren. If Emily is on the phone, why couldn't she have started that program a little earlier? I wouldn't have had to learn on the job so much because I'm a little older than Owen, so I didn't get the benefit of that program, but I participated in it along with Andy, been on the EcoE Advisory Council. I love that program. I think it's amazing. Lots of really interesting ideas and lots of great training for those students that have a desire to just explore entrepreneurship. And of course, with sustainability being a foundation of that exploration, I just think it's amazing.
Yeah, I mean, I would attribute a lot of success to Emily and the EcoE program. My master's thesis at Bren was a composting business, so on-site vermicomposting for schools. And we did a pilot project at, I'm blanking on the name. It's a private school in Santa Barbara. So we set up vermicomposting at the private school. And it went great. And I very quickly learned that I did not want to be in the composting business. And so it wasn't so much the specifics that I learned. It was, Emily reinforcing pivot until you hit a successful business model. And that's what I spent my first 2 years doing, was just kind of going down one path as quickly as I could, figure out it's either going to work or it's not going to work, and pivoting to something else that's better. I mean, and honestly, I would say that my pivot from Lumeo to Zero Net Energy Capital is a giant pivot. It's recognizing a more sustainable model. I would rather work with savvy investors and real estate professionals than bureaucrats in schools. So I think anybody at Bren, or anybody really that wants to explore sustainability and entrepreneurship, it's a huge selling point for the school.
Emily, you're not a bureaucrat, by the way. Said.
Everybody but Emily.
The school was Laguna Blanca.
Yeah, Laguna Blanca. There you go.
Yeah. Now, one of the things, so we in Sustainable Change Alliance, we obviously, with the local impact investing, we're obviously looking at investing in local companies, whatever. One of the things that we found when we look at a lot of the other local impact investing groups here in the US, that a lot of them do debt financing first rather than equity financing. And so when you look back in your times, especially more in the startup period, if you look at debt financing rather than equity financing, how would you have looked at that as an entrepreneur? I mean, what parts of it would have been attractive rather than equity financing, using debt financing?
I don't. I'm not actually a huge fan of that. Investor perspective.
Sound is falling out.
Okay, sorry. Yeah, I was just gonna say I don't. Is that better, Titus?
Yeah, it's better. Yeah.
Okay. I don't have. I kind of have a preference from an investor perspective to stay away from convertible notes and debt financing. I mean, I'm sure there are companies where that makes sense. An early stage company like the one that I started, or others that you guys have seen, Owen's talking about EV Match or whatever. I think it's important to be an equity investor from day one to help guide and influence to get to an eventual maybe larger funding round or private equity partner. actually, when I look at like what Owen's doing, it actually might be perfect. Debt financing might be perfect for working capital. So, I mean, it could be something that for certain companies, it works great. I prefer for myself to be an equity owner. And then even on the, I actually probably preferred it in running the company too, in that, you know, we really went through a tough time right out of the gate with the financial collapse. And we did have to sit around a table, and we did have to have peer-to-peer conversations. I wasn't talking to a lender. I was talking to an equity partner on my board about what the strategy is. I thought that was actually probably the healthiest way to have a tough conversation. So I'm not, so I do see that a lot, Titus. I'm not exactly 100% a fan of that.
Yeah. Mm-hmm.
Yeah, I don't think, I think I would have preferred equity for Lumeo, but honestly, where we're at with the ZNE, debt could be a nice fit depending on the terms. You know, most of our investments generate returns of 12 to 18% IRRs. So if the terms on the debt is less than that, I would just use it as our equity placement. So it could fit our model really well, but it would not have fit our model very well for Lumeo.
Yeah, and I would say, Titus, it's not easy. I don't envy the folks on this call that are interested in investing in some of these companies. There aren't as many as you would hope there would be. And do they align perfectly with everybody's desire and their scale and where they want to be in the life cycle of the company? There just don't seem to be an abundance of opportunities. There are other ways to deploy capital through intermediaries, infrastructure funds, that sort of thing, that definitely hit bullseyes on sustainable investments, but that's not that fun either. That's like, you can do that on your Ameritrade account. Yeah. So yeah, you know, I think it is a bit of a challenge. I think Owen and I are illuminating some of those challenges, particularly around really understanding, you know, what it is exactly do you want? Is it as a service? Is it renewable energy? Is it real estate? Is it something else? Is it small? Is it large scale? Some of those challenges you kind of have to iron out for yourself before you venture out into trying to find these investments.
Yeah. Excellent. Listen, we're coming up to an hour. Thank you very much for your participation. That was really great. Thanks, Matt, and thanks, Owen. And thank you very much for all the questions that came in. I don't know whether there's any other comments. I mean, Stephen, is there anything else that we need to do?
No, I think we're good. Thanks for a fantastic panel, Titus.
So thank you very much. And yeah, so everybody on the call, take a look at the Sustainable Change Alliance. We have these calls every 2 weeks. So maybe take a look on the website, and you can see what calls are coming up in the near future. And Matt and Owen, thanks again for your participation, and good luck with everything going forward.
Yeah, thanks, guys.
Perfect. Thank you very much.